So, hey, everyone, thanks so much for joining our monthly investor call. As you know, we do these monthly in order to provide an avenue for you to connect with us, on a periodic basis. And we try to give you, good content, great content that helps you just become a better investor, especially in the private world of investing, or the private investing world, which is somewhat, unique, but also in many ways more profitable and actually, probably offers a better peace of mind actually than what's going on with the market today. If you've been following the markets, the stock market off its latest high a couple months ago, it's down like 5%. It's dropped 2,500 points in a matter of quite literally 30, 45 days. So volatility matters. And I'm happy to, talk about what we do at Trophy Point in light of, RIAs and retirement accounts and things like that. So real quick about me, I see a few names I don't recognize on this call, so I'll just go ahead and give you my quick intro. I'm the managing partner. My name is Samir. I'm the managing partner of Trophy Point, and I've had quite a few roles, but largely around leadership and real estate. I own a bunch of real estate assets. I teach real estate entrepreneurship at the university level. I've overseen 200 million plus in real estate deals and lending. I mean, Trophy Point alone has done $200 million in loans to begin with. And there's a service aspect to me as well, which is, I serve in the military. I'm still in the reserves, actually. And I'm very proud from graduating from West Point and things like that. But what I'm probably more proud of is I'm always here to help. I love helping people solve problems, and I love helping people more than that, not lose money. I think real estate is a game that's about compounding your wealth. And what we do at Trophy Point, what Scott's going to talk about inside IRAs, speaks directly to that. Like, we are avenues for compounding your wealth responsibly. And, I can't say it's completely safe, but it's definitely safer than most of the asset classes out there. But as you can see from the little quote at the bottom, Mike called me up. He was trying to buy an apartment, a small apartment complex a while back. And I just asked him some questions. And it turned out those questions led to uncovering that the seller was actually trying to screw him over. And Mike would have been paying for that mistake for decades. And so I'm really proud of all the deals I don't do, actually, because we uncovered some sort of problem or some sort of issue. So I'm always available. My phone number is right there. My email is always at the bottom of almost every slide, so feel free to reach out to me anytime. So again, I'm going to give the quick spiel because I see a few names I don't recognize. But what we are is we're private money lenders. And basically our business model is like that of a private bank. We take your money, give you 8 to 12% on it based on how much money you invest, and I lend it out at higher rates of return, backed by real estate, backed by security, backed by liens on those real estate. So we're asset-based. So we're an asset-based lender. And that's what we do. And there's a huge need in the market for private lenders, to be frank, because banks are not lending less. If you remember from our previous call, like the number of banks has actually been cut in half over the last 20 years. There used to be 8,000 banks. Now there's around 4,000. And so private lending is definitely filling the gap. And we exactly take advantage of that because the banks are not lending. What's also different about us is that I have personally a lot of money invested in Trophy Point, and I take the first loss on any bad decision or bad deal we make. And I don't know of any other fund manager that does that. I firmly stand behind what we do. I'm not in the business of slinging loans just to earn yields and fees on it and then let the investors hold the bag. I'm going to eat it first if I make a mistake. And I think you want to be in bed with a fund manager that has just as much to lose, in fact, more than you do, because I have to lose all my money first before an investor's principal is touched. So I think we're very aligned with our investors, and we are very confident in what we do in order to offer that type of guarantee. And we, speaking of guarantee, we haven't lost money yet. We've had defaults. We've had problems. This is not a sunshine and rainbows business, but on the net of it, we haven't lost any money actually for our investors or for ourselves or for me personally. I'm very proud of that too. Here's our quick February update. So we made about $7 million in loans in February, and we got paid back on about $4.5 million. That's great. It's January and February. They're typically the kind of the doldrums, if you will, on real estate because not much transactions happening, but we're already seeing an uptick from January to February as well. And then December was actually one of our largest months ever, actually, if you're just joining us. And what I'm also proud of is that we send, $500,000 to $600,000 a month in interest to our investors. Either they reinvest it if they want to, or they accrue it to their accounts. And you can see we're $87 million in size. We've got 240 investors, and At any given time, we have between 300 and 350 active loans on our books. Again, if you've got questions, feel free to use the Q&A button or raise your hand. I'm happy to answer questions as we go along. There's a Q&A button or a chat button on your Zoom panel. We offer a referral. It is our interest and Trophy Point's interest to get as many investors as we can. We're always raising capital. I think the demand for private lending is only going to increase from here, actually. And we talked about it on a previous call, but basically, I think liquidity is going to be drying up. The government wants liquidity to dry up, frankly, in order to dry up to reduce inflation. But the need for private lending is going to fill that space because the banks are probably going to be lending even less. That's my theory. We'll see how it plays out over the next 6 months. But we have a referral program. Feel free to text us. We'll take it from there. A group text to that number, and we'll take it from there, and then we'll pay $1,500 either in cash or to your Trophy Point account. All right, I won't dive into this too much because I want to get to Scott, but we offer fixed rates of return, and it's bucketed by standard based on how much money you put in, and then the second bucket is your retirement. And one of the reasons why we love working with Scott, and I'll just kind of jump into my intro with him a little bit. I think what we do, I think private lending in general is a fantastic asset class for retirement accounts. We are optimized actually much better for retirement accounts because we allow you to compound your money at 10 to 12% based on how much money you put in a safer manner. And then, if you're in a Roth IRA, for example, that's all tax-free, and it's growing tax-free if you have other type of IRA. So I think if you've got retirement goals, I think you should really seriously look at private lending because growing your retirement dollars, which you don't want to take too much risk in my opinion, because it's your retirement, but you wanted to compound at a double-digit rate. I think what private lending does directly speaks to that. The team has grown. Part of my February update here is the team has grown dramatically. We've processed 30, 40 loans a month now, plus another 10, 20, 30 loans of payback. So that's a lot of volume. Millions and millions of dollars are passing through our hands quite literally daily now. And we've got a great team that I help lead, that Nick and Dave also help lead. And our ability to service our customers, our ability to close loans quickly, and we do what we say we're going to do, and we never miss closings. All that speaks to our ability to originate loans quite frequently. And 60% of our borrowers are repeat. And it's a testament to this team that we have assembled here before you. All right, so let's get to the best part of today, self-directed IRAs and RMDs. And I don't want to steal Scott's thunder too much, but I do want to give a quick plug for Advanta. Now, I'll say on the record, we don't pay each other. There's no, financial relationship necessarily between Advanta and Trophy Point, which is good. We advocate you should do your research. There's many custodians of IRAs out there, but we like working at Advanta because of the personalized service. Because Advanta is probably on the smaller side, which is actually a good thing because there are larger custodians out there, but you're just a number. We're just a number when we try to talk to them, and it's so hard to get things done. But what we love about working with the Advanta team is that Danielle and myself, or you as the investor, you can just call up Advanta, and they do a fantastic job of answering questions, making sure the paperwork is correct, and making the process seamless. It is possible with other providers that it could take months sometimes to transition your retirement dollars from your Fidelity, Schwab into a custodian. But with Advanta, we've got it down to within weeks, sometimes less than a week, actually, if all the paperwork is straight. So we love working with the Advanta team. I think you're not going to find better service from any custodian other than Advanta. And Scott, when you get a chance, please talk about what a custodian is. I think it's in your slide somewhere, but please make mention of why a custodian is critical to investing via self-directed IRA.
Okay.
So what I love about Scott is that, he's a triple threat. He's been with the business for a long time, which is great. You always want to see folks with their teams or with their businesses for a long time. He's in the business of talking to investors, and he listens very closely to what's going on in their situation. And then on top of that, he's an attorney as well. Now, he's not really trading legal advice here, but I feel much comfortable knowing that there's an attorney always on the other side, kind of with a watchful eye of what's going on, because we just, at the end of the day, we don't want your retirement dollars to be categorized in a manner that loses its qualification as retirement dollars. But anyway, Scott's info is right there. You're welcome to contact him anytime. And you're also welcome to contact Danielle Banks, our investor relations manager, who also helps facilitate the relationship on getting your IRA set up. Scott, that being said, I'd love for you to take it over.
Sure. Good. Yeah. Thanks, Samir. Thanks for the kind words about Advanta. As you mentioned, there's no relationship between our firms financially. It's just, we help service clients who choose to use their IRA, maybe their old 401k funds, to invest with Trophy Point. So that's kind of, we help facilitate that arrangement. I'll maybe start with that question, Samir wanted me to cover right off the bat, is having an IRA custodian for every IRA, whether it's with a brokerage firm, bank, whatever. The IRS requires that your IRA funds be held with a custodian. There's a lot of different types of custodians out there. There's custodians who hold brokerage assets, they hold CDs, but there's custodians like ourselves who are willing to hold what we deem to be, we call in a big bucket of alternative assets, alternative investments that you are permitted to hold within your IRA, as long as you have a custodian who's willing to do that. And that is what we do as a custodian at Advanta IRA, is hold assets that the Schwabs, the Fidelities, those companies simply choose not to hold on their platform. You can certainly, the IRS will allow you to invest in them, but you have to have a custodian who's willing to hold it. And that's what we specialize at Advanta IRA. You can see in the slide, we have over 20 years of experience. We currently have over $3 billion in assets under management. I think about 13,000, close to 14,000 active accounts currently that we administer. As Samir said, we're smaller in the sense that we're not as large as some of the huge custodians, where you do become a number, where you call into an 800 number and get placed in a call queue. We're small enough that we still maintain that every new account gets assigned to an individual account manager who gives you that level of service, that one point of contact that you should deserve and you should expect for your custodians. That's really how we try to set ourselves apart from the other companies in the industry. We also do like to provide a lot of educational events, and I appreciate Samir having me on today to talk about that. Do I have the ability to change the slides, Samir, or is that?
Yeah, why don't you try? Actually, we've never done that, but go ahead and try if you can.
No, it's not letting me advance, unfortunately.
Okay, I'll take it over for you.
Okay. Yeah, so again, just a quick disclaimer, we kind of mentioned already, we don't provide or endorse any particular investments or investment products. Do your due diligence. Do your due diligence on the people you're investing with. Do your due diligence on us, as Samir said as well. We are happy to process what you bring to us, but we also, it's up to you to make sure you are comfortable with who you're dealing with, investments you're making, how much you're investing. So it's kind of self-directed IRA is the kind of thing. Well, I think there's a slide coming up in a moment, but self-directed is not a type of IRA the IRS recognizes. Samir had a slide up that listed like your traditional, your Roth, your SEP IRA accounts. Those are the types of IRAs that the IRS recognizes for different tax reasons, contribution reasons, etc. Self-directed really refers more to your ability to invest in assets that you can control or that you choose on your own. So you can have a self-directed traditional IRA or a self-directed Roth IRA account where you're not picking from a list of mutual funds. You're actually going out and selecting the specific asset or different asset classes that you want to hold. So the power really is in your hands to decide how you're going to grow your retirement accounts. All right, next slide. So again, you can bump through this slide too, Samir, too. It's kind of, again, what a self-directed IRA is, and then really why people are choosing to self-direct. For some, it's a new source of capital for them to use. So if, for instance, use an example, you've already invested with Samir on a personal note. You've already put some money with him. You like the returns you get, and there's another investment possibility you want to take part in. Your IRA may just be a different source of money for you to use towards that particular investment. Again, most people don't realize they can use their IRA account to invest, outside of the stock market into these types of assets. So they may already be investing in different types of alternatives. They see another opportunity arise. They decide to use their IRA, their old 401k, to then make that investment. For a lot of clients, I'm guessing we're going to have some of you on the call right now and in the weeks ahead that are just tired of the stock market roller coaster, right? The market's been doing well. All of a sudden now a couple of changes are made, a couple of statements are made in government. Now we're seeing, as Samir said, the stock market's taken quite a hit over the last week or two. And that's people's 401ks. That's your IRA. That's money that you're counting on, invested in a market maybe that you don't understand or that you don't trust. And so being able to have the choice, have the ability to move some of the money out of that account into an alternative where you do have more control over the investments and the investment classes. So really the main reasons people invest with self-directed IRAs is, again, they have a different source of capital and the ability to really properly diversify and get some of their money out of the stock market. And as Samir mentioned as well, the tax nature, as you invest and reinvest in IRAs, that money is growing either tax deferred with regular IRA accounts, or if you have a Roth account, that money, the gains you're getting is actually accruing back into your Roth IRA completely tax free. You're not going to pay tax on that money when you pull it out in retirement. We're going to be talking about distributions here in a few minutes as part of the topic today.
Yeah, and I'll quickly chime in. Almost half to two quarters of our investor base at Trophy Point is over the age of 55. And we tailor our investing style for that, right? Like we're really more about not losing money than making money, I guess. Like we're not going to triple your money in 3 years or anything like that at Trophy Point. That's why like we're so optimized for not losing money. And I think IRAs are an excellent way to grow your money sensibly without the volatility that you're seeing, especially over the last few months in the stock market.
Yep. I'm going to go next slide. Yeah, and I would say, in piggybacking on what you said, Samir, too, I think one of the reasons why we do see a lot of people investing into private loans or private funds is, a lot of people who have IRAs and 401ks, it is not a set it and forget it investment, but it is kind of like, let's put it aside, and it's not something you check on all the time. You kind of get your investments in place and you want to let them sit because you don't have the time maybe to deal with being a more active trader, or in the case of alternatives, buying and selling real estate, where maybe you're dealing with actual tenants and the maintenance items and things like that. Private loans are a great vehicle if you're interested to be able to invest in something that's going to pay you back. Maybe a monthly payment comes in, maybe a yearly payment, whether it's compounding or not, but something you don't have to actively manage. You get the investment set up and it kind of gets working on its own, and those gains come back to you. That's, I think, something that's very attractive to a lot of different investors. I mean, and most people don't know that you can invest in private loans and real estate and other types of assets, because most IRAs, whether it's an IRA or maybe an old 401k, those accounts are with banks and brokerage firms who are offering you really investments only in what they sell on their platform. That's going to be typically things that are publicly traded. They could, if they choose, allow you to invest in a lot of different alternatives, but they choose not to. It's not their business model. They're not going to tell you that you have other options because they don't want you to go elsewhere, right? They don't want you to take some of that cash you have and go invest with Trophy Point, or go invest in a piece of real estate or a private fund. They want to keep their money there. So they're not going to tell you it's available. You have to hear about it from someone like myself or Samir, or webinars like this to realize what options you have. The IRS regulations only prohibit you from investing in life insurance and collectibles. Those are the only two prohibited asset classes. But not every custodian can hold every asset or has to hold every asset. So the list of alternatives includes real estate, physical properties, mortgages and notes, private funds, syndications, precious metals. Again, a lot of different things. As long as they're not considered life insurance and collectibles, you can make those investments inside of your IRA account. So what accounts can you self-direct? I mentioned again, self-directed is really a marketing term. It's not a specific type of IRA. But you can self-direct and use money from any type of IRA that you have. So whether it's a traditional or a Roth IRA, or maybe you've inherited an IRA from a loved one and you have an inherited IRA now. If you are a small business and you have a SEP or a simple IRA, you can always self-direct any account that has that dominate. Any account that is in some type of IRA, there's no restriction on you self-directing that money. If you're a small business, you may be able to set up a solo 401k for yourself. In addition to the IRAs, the other bucket of money that people often forget about that you can use is any money that's sitting in a former employer's plan, like a 401k, 403b, TSP for military individuals. You can roll over any former employer's plan into a self-directed IRA. The only accounts that you have some restrictions on will be current employer plans. If you're currently working for the company offering your 401k, you may not be able to move that money until you leave the company. But again, just note any type of IRA, and it does not have to be the full amount. You can invest as much or as little as you want from your IRA account into a self-directed vehicle.
Scott, I'm glad you mentioned the former employer stuff. What about defined pension plans?
Yep, pensions. Yep, pensions. Any type of defined benefit plan from a previous employer, absolutely. Again, the restriction when it comes to any type of an employer plan, and there's 401ks, there's pensions, there's cash balance, there's different types of plans. As long as it's a former employer, there's no restriction on moving the money. It's only the current employer where you have to check and see kind of what your availability is to access those funds.
Nice. Cool. Again, if anyone just joined us, and I think a couple did, feel free to throw your question in the chat, throw it in the Q&A button, or raise your hand. Either all those three will work. Here's where the rubber meets the road, actually, for the discussion for today, which is IRA distributions. And RMDs are a big topic. And I mentioned that because, half to two-thirds of our investors are over the age of 55, approaching the age of 59 and a half, in which some things have to happen. Some forced churn is about to happen to you when you turn 59, 59 and a half. And so go ahead, Scott. Thanks.
Yeah, no, yeah. So the obviously the genesis of IRAs is to save money, put money away, invest it, have it grow, so that when you hit retirement age, you can start pulling money out of that account to have for your living expenses, vacations, just as your income, maybe as you're hitting retirement. So the IRS does have certain distribution rules when it comes to these accounts. So when we're talking about IRAs and 401ks, the distribution rules follow a lot of the what we're going to see here on this screen. The benefits, again, of IRAs is when you're investing and reinvesting is that you're not paying tax every step of the way. So every time you get a payment in on your investment, you don't have to pay tax on it. When an investment pays off, you don't pay tax. You're only going to pay tax on any non-Roth IRA account when you pull money out in retirement. So the IRS is giving you great tax benefits, and they want you to keep that money in there as long as possible. So when we get into talking about distributions, if you are under the age of 59 and a half, the IRS will hit you with a 10% early withdrawal penalty if you take money out prior to age 59 and a half. That is their disincentive to you. They would like you to leave that money alone, leave it in the IRA, allow it to continue to grow. Again, the benefits behind that, the more money that you have in your IRA from a government standpoint, the less likely you're going to need government services. So it's more money that you've saved on your own. So they don't want you to touch early. So anything before 59 and a half is hit with a 10% penalty. And for any non-Roth accounts, the amount you take out also is included in your ordinary income for that year. So any regular IRA or 401k, you have ordinary income tax on the funds starting at that time. Now at age 59 and a half, the 10% penalty goes away, but the distribution isn't still included in your ordinary income, except for Roth IRAs or Roth 401ks. Those distributions come out to you completely tax-free. So that's the benefit. I don't have enough time maybe to go into all the benefits of a Roth versus the other accounts, but just know that with a Roth, your money is growing tax-free. So when you hit age 59 and a half with that account and you pull funds out, no taxes required at all. But for regular IRAs and 401ks at age 59 and a half, what you pull out is included in your income, but there's no early withdrawal penalty. So at age 59 and a half, you can take money out if you wish without penalty. You're not required to. We'll get into the required distributions in just a second, but just a couple notes on the inherited IRA. If your spouse is the beneficiary, or if you inherit the account from a deceased spouse, you get to treat the IRA as your own, and you're subject to the distribution rules that I already talked about. If, though, you inherit an IRA from somebody who is not your spouse, you must fully distribute your IRA within a 10-year period, and you must take a RMD, or which is short for a required minimum distribution, each year during that 10-year period. So the IRS, when you inherit an IRA from a non-spouse, expects that you're going to fully distribute that IRA account over that 10-year period. We can go to the next slide and talk more about specifically about RMDs. So required minimum distribution. So again, penalty-free distributions start at age 59 and a half. So at age 60, 61, 65, you can take money out of your IRA if you choose without penalty. But once you hit age 73 and you have a taxable IRA or a 401k, so a traditional IRA or a SEP IRA or a rollover IRA or 401k, the IRS will require that you start taking out a minimum distribution every year from that account. It's usually about 3 to 4% of your total account value. The RMD is calculated based on your life expectancy each year. But one of the things, and we're going to talk about as we get into a couple of the case studies, and Samir wants to talk about probably as well, is if you're at the point where you're starting to take required minimum distributions, it is much easier to take distributions of cash than it is if you're having to take distributions of a portion of a loan or a piece of real estate. So you want to have cash flow or the ability to get cash flow back into your IRA account to satisfy that RMD. Again, RMDs typically are 3 to 4% of your total account value. They start at age 73 and continue each year thereafter. So again, it's something maybe not everyone on the call is subject to yet, but it's something to consider as you reach that age, that you want to have some cash flow coming in to meet that RMD and not have to eat in to any principal or of the investments that you're holding. One other note on RMDs. You can satisfy your RMD from any IRA that you have. So if you have multiple accounts, you add the value of all of those accounts together, go to the life expectancy tables, figure out what that RMD is for that particular year. And then as long as you take that money out from one of those IRA accounts, that will satisfy your total RMD. You do not necessarily have to take an RMD from each separate IRA. I hope I made that kind of clear. But again, with inherited IRAs, the special rules, again, the spouse IRA is treated the same. If you're inheriting an IRA from someone who is not your spouse, you must take an RMD every year during that 10-year period, and also make sure you fully distribute your account during that 10-year. And again, last thing I'll mention on the distribution, unless there's questions or if Samir has anything he wants to add, Roth IRAs do not have an RMD requirement. I think if you helps to understand why Roths have none and why traditionals do, you take that little skeptical view of the IRS and that they're hungry for tax revenue. With traditional IRAs and traditional 401ks, that money is going to be taxed at some point. They've given you some tax deferral all along. So at age 73, they kind of knocking on the door saying that's enough. You need to start paying some taxes on the money. But with how Roth IRAs are set up, since there is no tax revenue going to be realized, the IRS at that point doesn't care if you take an RMD or not.
That's a great distinction, Scott. And the other thing I want to, as we get to the next slide, actually, I want everyone to think about the word illiquid. I think the most important word actually on the slide is illiquid, or actually 3 words, illiquid and cash flow. And the illiquid nature of certain investments that you make, whether you do it inside an IRA or actually you do it even, in a regular stock portfolio, there's some serious implications about what is illiquid and what you want to sell or don't want to sell, and how cash flow has a big part of that as it relates to RMD. So I don't want to take away from Scott's next few comments, but just think about what the word illiquid means to you with the assets that you hold and the implications of that as we talk about IRAs.
Yeah, we can go to the next slide. So you want to get started with a self-directed IRA. You want to make an alternative asset. The question you're going to probably then be faced with is, how do I actually move this money into a self-directed account? I have an IRA with a brokerage account like a Schwab or a Fidelity. How do I get that money moved over? And you can do it in one of 2 ways. The first is doing a transfer, which is typically transferring or moving money from one IRA at one firm to an IRA account at the other without you touching the money. So you fill out a form, in this case with us at Advanta. You fill out the form, you tell us, here's my other account, here's my account number, and here's how much cash I wish to transfer. We submit that form to your other custodian to have that money moved. The money goes, Samir mentioned, usually takes a couple of days. It's a non-taxable, non-reportable event when you do a direct transfer from one IRA account to the other. And you can do these transfers as often as you'd like, as long as there's the proper form going back and forth each way. If you're setting up an account with us, we are going to help you get the transfer form completed, help you and submit that on your behalf and follow up and make sure that money gets moved over. But again, I think it's important to always note, because you can do as many transfers as you'd like, self-direction does not have to be an all or nothing strategy for you. So if you have $500,000 in an IRA, but you only want to use 100,000 or 200,000 to make a specific investment, you only have to move that amount over at that time to make the particular investment. You could always move more money over later if you found other opportunities as well. So transfers are IRA to IRA. And if you go to the next slide, Samir, the other way to move funds is considered a direct rollover. And this is when you have funds that are sitting at an old 401k or one of your old employers. It's just a little bit different process. You have to actually call the administrator of your plan to have them send the check to the IRA account that you've opened up with us. It's again just in our industry with IRAs, we can request a transfer. When it's coming from an old 401k, an old 403b plan, you have to call an initiated. Again, it's also a direct rollovers are non-taxable events. As long as that money is never touching your hand, it's never going into your bank account, You can do transfers, you can do direct rollovers whenever you'd like in any amounts and move that money back and forth between different IRAs and different plans.
And just one real quick thing to add. I know that sometimes this could feel a little overwhelming. And so Danielle on our team is really well adept at getting this done for you. And in many ways, many cases, she'll fill out the forms for you. You still have to sign it, of course, but Danielle on our side, on the Trophy Point side, is a great resource, and she'll all but fill out the whole thing for you, with your consent, of course, to help you to do whatever side you want to go, whether it's direct or you want to set up a brand new SDRA.
Yep. And yeah, and so I mean, before we get into the case study, yeah, just to illustrate, I mean, we're happy to help out, obviously, as well on our side. If you're not sure, hey, I know I have an account at Schwab. I'm not sure what type of an account it is. Is this a transfer? Is it a direct rollover? If you send me a screenshot or the first page of your statement, I can look at it right away and tell you whether it's going to be a transfer, whether it's going to be a direct rollover, and then give you the instructions on kind of what the next steps are for you. Yep. So our first case study, we're going to talk just kind of about an individual loan. Kind of one way you can do a private loan. In this case, Andrea has money in her IRA account. She meets Steve. Steve invests in real estate. He's looking for capital for his next project. But it's kind of talked earlier. Maybe Andrea has a 9-to-5 job. She doesn't have time to go out and manage real estate personally. Doesn't want to be, add that to her plate of all the things she has going on. But hey, she could lend money to somebody else, let them do all the work, and have them simply pay her back. In this case, it would be paying back to her IRA account. Again, important for Andrea to do her due diligence on Steve. That's who she's going to lend to, and the property that he's looking to purchase. It's, if you're lending money, you want to know what the backup collateral is as well. So Andrea agrees to loan him money for the property. He's going to put his own down payment down. She's going to lend him the money to purchase the rest of the property, get it fixed up, and get it ready to sell. So we can look at the numbers on the next slide. Or actually, no, maybe not this. Well, just really quick, just on private lending, when you're doing individual private lending, you're the bank. You can determine, obviously, amount someone's borrowing from you, the interest rate you're going to charge, how long is that loan going to be out for. So just want to make sure that's clear. So now when we go to the next slide and look at the terms, that's between, in this example, Andrea and Steve. She's going to lend him 150 grand at 8%. She gets that loan secured by a first mortgage. At Advanta, we don't draft any of the paperwork. And I know that when we work, obviously we work with Samir and Danielle. They have their own investment paperwork that they help put together. We give them the legal wording to use for the IRA. That's one of the important things on our side at Advanta is whenever you make an investment, we want to make sure that the investment documents properly show your IRA account as the actual investor. In this particular example, that means your IRA is going to appear on the note and mortgage. In our next example, it's going to appear on like subscription documents for the private fund. So that's an important job for us, is to make sure that the investments get properly titled, and also make sure that you as the client review and approve all those documents as well. So we're not going to send any cash out of your account until you have initialed off that you have reviewed and approved the actual investment paperwork. So you're involved certainly upfront in this stage, evaluating the investment, making sure the terms are correct, making sure that's what you've agreed on, especially in this instance with Andrea doing a loan to Steve. She needs to make sure she reads those documents to make sure that everything gets properly titled. In this example, Steve rents the property. He's able to rehab it, rent it out, and sends that $1,000 interest-only payment back to Andrea's IRA account. So she's got cash flow coming back every month to her IRA. She can withdraw those funds from the IRA as a distribution if she wishes, obviously subject to the rules that we talk about later. If Steve refinances at a later term, she's going to get her initial principal back as well, and she would have had that cash flow all along from the loan as well.
And real quick, let me just jump in. We've got a question. I'll get to that in a second. But just to take one step back, when you're investing in private notes, at least, you can do it kind of two ways. You can do one-on-one, which in this case, it's Andrea and Steve. Andrea's doing it directly with Steve, and pretty much all of the 150,000 that Andrea lent to Steve is at risk here because it's one-on-one. The second way you could do it, which is the way Trophy Point operates, is you could invest in a fund or a pool of private notes, and the benefit is that you're diversified across the entire pool, actually. So in Trophy Point's case, just as an example, like we've got 350 loans at any given time. And the way we do lending, like, your dollars do not depend on the performance of just one single note, whereas Andrea, in this case, would be subject to whatever happens to Steve. Whereas when you're investing in a pool of notes, you get a lot more diversity, especially in a fund like Trophy Points that has 330 notes at any given time. So I just wanted to make that distinction here so you understand. And I think Scott's going to talk about the pooling in a second. But real quick, we got an anonymous question. This is definitely for Scott. I'm going to answer this live. Can RMD withdrawal, I'm not sure if I understand the question. Can RMD withdrawal tax implication differed via backdoor conversion of Roth? So I'm thinking he's asking, is there an implication, I guess, when you do a backdoor conversion to Roth?
Yeah, so so a backdoor conversion to a Roth is taking, if you're not able to contribute to a Roth account, sometimes people will contribute money first to a traditional IRA, which is tax deferred, and then do what's called a conversion and move it to a Roth IRA account, which is now growing tax free. So it's a backdoor Roth is a way to get around some of the restrictions for direct contributions to a Roth account. However, with RMDs, once you hit RMD age and you're pulling money out of a traditional IRA account, that distribution has to come out of the account and be distributed to you. You cannot simply roll that money then back over or into a Roth IRA account. So the traditional IRA distribution comes out to you, and that's it. Now, if you're still working and still able to contribute to a Roth IRA, that might be a different story, but you can't simply convert your RMD amount over into a Roth account. So the money has to come out and stay out of the IRA.
Oh, interesting. Cool.
Yep. So yeah, great point, Samir. On the last example, we'll talk now about investing in a private fund. Yeah, and in that deal, Andrea is one-on-one with Steve. If he performs and does great, awesome for her. It's up to her to do her due diligence. But we've also seen many people, obviously the people we've had that have invested with Samir, invest in a private fund rather with their IRA or with their 401k funds. And a lot of the process is the same initially. I didn't cover it in the last example, but Andrea, or in this case, John, if he's looking at making an investment, his first step is to establish an account with us, filling out our paperwork, naming his beneficiaries, and then telling us, where his funds are located. So in the initial setup, the initial starting is the same regardless of what investment you're making in Advanta IRA. It's about establishing the account first and getting funds transferred or rolled over. Where things will differ, in the last example, Andrea is doing a one-on-one deal with Steve. She's doing her own due diligence. She's looking at the note and mortgage documents, making sure they're what she wants them to be. But in this case, John, he has money in an IRA. Jane has a private offering. She raises capital for various lending projects. John's not going to be evaluating all of the different various lending projects. I mean, he probably could ask for some information on some of them, but more of John's due diligence is probably going to be on Jane and her company and what they do with the capital, and looking for some history of how they've performed and whatnot. But he's not going to be involved in doing and authorizing each individual loan. He's going to be a little more, even more passive than Andrea was in the last example. Rather than investing and having us review a note in a mortgage, so the first case study, Andrea has to draft a note and mortgage document that Steve's going to sign. In this case, if John's investing into a private offering in a private fund, his investment paperwork will be in the form of subscription documents and probably a prospectus that Jane has provided to him to look over. Like, if you want to invest in our fund, here's our history of the fund. Here's how we've performed in the past. Here's who our principals are, who's involved on the decision-making side. So John's still going to open up his account, request the transfer from Vanguard to get that money moved over. And as we go to the next slide, our role at Advanta will be to make sure, in this case, that the subscription documents get completed in the name of his IRA. We're not looking at each individual loan that's being held in Jane's portfolio. We're looking at the subscription documents for John's IRA. John is looking to join this fund. Those are the investment documents that are used for someone to join the fund. And again, we need to make sure that his IRA is properly listed as the subscriber. And we use our tax ID number, not John's social. So every month, if there's payments coming back, they're going to come back and be paid to John's IRA account. And the reporting is going to be done by Jane to our tax ID number, not John's social. Ultimately, we will sign the subscription documents. We will send a wire out of the account to fund the investment. And then going forward, in this particular example, the fund sends a monthly dividend to John's IRA. $800 comes back into the account. Those gains are not initially included in his income because that is money back to his IRA. But if John then elects to have us send that dividend to him as a regular distribution, at that point, the distributions are included in his income. And since he's 73, that's going towards John meeting his annual RMD requirement. So he's getting, again, cash flow from this investment in this private fund, and that cash flow is then being used to satisfy his annual RMD. So it's kind of, it's, as Samir said, a different way to invest in private loans where you're just investing in a fund. Somebody else is going out there selecting the different loans to make, as Samir said, maybe reducing some of the exposure for loans that maybe don't perform as well as they should because you have a larger portfolio. And John's able to then get this consistent return back into his IRA account.
Yeah, and just to jump in real quick, the distributions, many people ask, but we do not do this. We cannot do this. I have to send the money back to your custodial account because technically the investor is actually the IRA. I mean, it's for the benefit of you, the individual, but technically the investor is actually your IRA. And so any distributions we get, I can't send it to your personal checking account. We send it only back to your IRA if you choose to have the distribution in the first place.
Yeah, great point, Samir. Yeah, the money has to come back to us as your custodian in this example. And then you just have a form on file, though, that says, hey, every month, send me X number of dollars. Basically, we get the check from Samir, from the investment provider, comes into your IRA, and then you have a form on file that we then in turn send it to you. It sounds like, hey, that's a hassle. Why can't it just go to me? I will tell you one thing. It keeps the IRS happy and off your back. If you were taking distributions directly from the investment, the IRS could look at that as a prohibited transaction as opposed to just a qualified regular distribution. If it becomes prohibited, now you're in an argument and discussion with the IRS as opposed to taking that one extra step that just adds a day or two to the process.
And it's our policy to send the money back to the custodian because then if you want that distribution for the purposes of satisfying your required minimum distribution, it's done through the custodian, not actually from Trophy Point. So there's much more defensibility in terms of, hey, it's in a qualified account, and it's the qualified account, which is your IRA with Advanta in this case, that is actually doing the distribution, not the investment itself.
Yep. Go to the next slide. Yeah, so I mean, cash flowing assets, obviously it could be rental real estate, oil, gas, mineral rights. We've been talking a lot about the private loans and notes. There's syndications, there's private lending funds, private placements, just something to consider. If you don't have a cash flowing asset in your IRA and you hit RMD age, you would have to start picking and choosing which investments to either liquidate or maybe liquidate a portion thereof to meet your RMD when you hit age 73. So if you're not there yet, great, because you have time to maybe rebalance your portfolio a little bit, look at which investments I can start getting a consistent cash flow from, so that when you do hit RMD age, if you have cash flow coming back into the IRA, you're not touching the principal, you're not touching the other investments, and you're not having to then kind of liquidate in a hurry to meet that RMD. The IRS does have penalties if you do not hit your RMD any given year. They'll hit you with a substantial penalty. It used to be 50% of the amount of your RMD. So if you had a 10,000 RMD that was due and you missed the deadline, the penalty at one point was $5,000 of that 10. So you just gave up half of your RMD back to the IRS for not taking it on time. The penalty's been lowered over the years. I can't remember what it is now. I want to say it maybe is 25%, which is still pretty significant when it comes to penalties. So if you have a cash flowing asset, that's going to be easy to set up, just a recurring distribution to you over the course of the year. Your RMD is getting met. You're not trying to scramble at the end of the year and flirt with those penalties.
And I think that's kind of goes back to my original sort of point I made a few slides ago. You don't want to, I don't think if you've got good assets that are growing, you don't necessarily want to pick and choose what to liquidate each year. I think that becomes a very taxing and exhausting exercise if you have to do that. And so my recommendation is especially for IRAs, private notes in many ways represent probably the safest or maybe the more safer asset classes that cash flows and yet still allows you to maintain a degree of liquidity. You don't necessarily, if you've got a growing asset, let's say stocks even, in a company that you like, that you know is going to be worth even more in the future, and you want to hand that off to your kids 5-10 years from now or whatever, you don't want to sell shares of a growing or appreciating asset. But having some money in a cash flowing asset like a note, for example, which is secured, it allows you to not pick and choose those other appreciating assets that you have. And I think that's actually the key thing that we're trying to come across here with our RMD discussion and the whole discussion for today.
Yep. All right. So I mean, getting started is easy. If you're looking at using your IRA for these types of investments, which again, it's a great way to diversify out of the stock market. It's a great way to get some cash flow coming back into your IRA that you may not be getting through your mutual funds or stocks. It's simple. It's filling out the paperwork with us takes 10 or 15 minutes. Funding the account can you fill out a form with us. It may take a few days to a few weeks. It just depends on your other custodian to get the money to us. And then you're telling us about the investment, right? You're letting us know who you want to invest in, and our job is always going to be to make sure that the paperwork gets properly titled. Make sure you've reviewed it. Make sure you've approved it before we send any money out of the account. But it's a way to take advantage of these types of assets that Samir has and these types of investments inside of a tax deferred retirement account.
Wait, we got another question. Prince asks, how does Advanta IRA differ from a specialized real estate accounting firm that offers IRA services?
From a specialized IRA accounting firm, that I'm not familiar.
Yeah.
I mean, there are companies that may offer IRA services, like they'll, I guess there's, honestly, I'm not sure how to answer that. I mean, there's accounting firms that maybe help you give you some advice, some counsel on how much to contribute to an IRA. Maybe they're tracking your IRA account and its gains, but you still have to have a custodian for your IRA account. And that's what we do at Advanta. We're fulfilling that role as a custodian. An accounting firm, unless they've been approved or they're acting as a trust company, they're probably not a custodian. They may be offering you other services to record keep your IRA account, but you still need to have an actual custodian who handles all of the IRS reporting. I'm not sure if the IRS would accept a 1099 from just an accounting firm. They need that to come from an actual IRA custodian. So that's the role that we're serving. We're custodying the assets, we're record keeping them, we're doing all the IRS reporting. I'm not sure that, accounting firms do a lot of great work, and they can certainly do a lot of great work with your IRA, but you still have to have a custodian that holds title to the assets, and that's what role we perform.
Yeah, and there's actually a distinction because those accounting firms are probably providing tax advice on how to allocate your assets based on tax considerations, and Advanta does not provide tax advice either, right? So
correct.
That accounting firm may be doing a lot of the, I guess, legwork in terms of understanding where to invest, what the tax implications are, what your estate implications are, maybe even giving you advice on like an RMD strategy. But in terms of actually holding the money, it has to be done by a custodian. And the custodian, vice versa, doesn't provide you the advice. So they may go working hand in hand, but I'm not aware of any accounting firms or tax firms that also act as a custodian. They probably don't want to, actually.
Right.
The more I think about it.
Yeah, there's a lot of regulatory things we have to make sure we're in line with. But yeah, I think that was a great synopsis, Samir. I think, how you certainly, an accounting firm can give you advice. So someone asked that question about backdoor Roths and converting to Roths. They give you that advice that we can't. I mean, I can tell you how it works and what the rules are, but whether that's a good idea for you, that's more of a discussion to have with your accountant or accounting firm.
Yeah. Well, we're coming up on time. Scott, well done. I appreciated how you explained everything pretty clearly.
Well, thank you. I appreciate you having me on.
Of course. And so we've got about 5 minutes, or 3 minutes rather, to the top of the hour. So if you got any questions or comments or anything you want to do, you got the chat button, you got the Q&A button, or raise your hand and we'll open it up to you. So today, I'll summarize while we get some additional questions. But basically, today we covered what are private notes. They have terms, they have interest rates. They're great in terms of cash flow. We talked about what are IRAs, how you can set one up, the implications of setting one up in terms of your tax planning in a general sense. And then we talked about RMDs, which are something that everyone that turns 73 is going to face at some point or another. In our case, most of our investors are on the older side, which is why we wanted to invite Scott back, because a lot of our investors are about to have the same conundrum when it comes to picking and choosing and selling and distributing the assets held in their IRA. So we got one more question here. Oh, Chris, thanks. Chris says, thanks for hosting and having Scott on. Thanks, Chris. Valerie, you wanted to know his email address again. Sure, let me go to that slide.
It might be on the next slide. And I actually realized I had a slight typo on the first slide.
Oh, so
yes, it is actually SMAURER at advantire.com. I saw that earlier. I was like, oh my gosh, I can't believe I missed that. But It is my first initial and my last name at advantaira.com. If it doesn't, if you write it down wrong or something happens, Samir has it too. He can connect you with me also, or you can simply just give me a call at that number too. A lot of times people like to email some questions, but the questions then are something that I don't want to write a book back to you to explain. And it's a lot easier to have a phone conversation. So I'm very happy to, at that point, get on the phone with you and go through your scenario. So always available for that. Like I said, we always appreciate working with Samir and his and Danielle and his team. They make it easy on us too, as with some of the paperwork and documents.
Yeah, and I think we've got now millions of dollars flowing between Trophy Point and Advanta,
Yep.
so we take the relationship pretty seriously.
Yep.
But I'll say again, like we don't pay each other, and I think you, as
Yep.
any prospective investors or current investors on the call today, like you should just know that you're welcome to choose any IRA custodian, but there is a difference in quality for sure. And most of you are busy working professionals, or you've got great lives in retirement. And I think the last thing you want to do is fight with your IRA custodian on paperwork, because it can be a very daunting thing. And Advanta does a fantastic job of making it super easy for you, which is why we generally recommend Advanta for everyone that comes through the door.
Yeah, like I said, I appreciate it. Like I said, there's no financial relationship between us at all. You can have an account with us and choose not to invest with Samir. You can choose to use your IRA with Samir and not use our firm. So, but like I said, we have worked well together, and I appreciate you having me on today to help share my knowledge, and look forward to coming on again sometime.
Likewise. Thank you so much. Any last minute questions from the crowd before I end it? Looks like we got one more. One second. Oh, Sanjay says thanks. Thank you, Sanjay. Appreciate it. All right. Well, everyone, thank you so much. Have a great rest of the week. And Scott and I are only a phone call away if you need anything. Thanks so much.
Yep. All right. Thanks.